Welcome everybody to Wall Street Reporter's next Super Stock live stream, February 16th, 2021. We have a debut presentation today from Reliq Health Technologies, RHT, on the TSX Venture Exchange. For anybody that's new to our program, our goal with these live streams is to bring you those stocks which have that 10x to 100x upside potential. So these are companies which have three things in common. They're going after multi-billion-dollar market opportunities, so massive market opportunities. They're at a key inflection point right now with, massive growth to come, and they have multiple catalysts in place. Those of you who've been following our program have already seen we've had a bunch of 10 baggers or 20 baggers even in the last 18 months. The most recent one, of course, is CBDT, which just in the last 4 months is up. I think it's like 1,700% as of today, from a nickel to 80 cents or something like that. So today we're going to find out if Reliq is going to be that next 10 bagger. The stock is 88 cents. Very auspicious number in a Chinese New Year right now. So this is a good number. So our audience wants to know what's going to be the path. Can this be an $8.88 stock? So with that said, Lisa, we're gonna start. I'm gonna ask you a couple of questions, but the main thing is, for those of you watching, please ask your questions, because it's your questions that really are key to this, and then decide for yourself if Reliq is going to be our next 10 bagger. So with that said, Lisa, welcome to the program.
Thank you for having me, Jack. Very excited.
I know we got a lot of fans here. A lot of people very interested in knowing what you're doing here with the stock. So, Lisa, for anybody that's new, again, in a snapshot, what does Reliq do in the health tech space?
Right. So we're a digital healthcare company, and essentially we provide virtual care to patients, typically with chronic diseases, but chronic disease includes things like managing mental health conditions. We sell to healthcare organizations, so physician practices, home health agencies, skilled nursing facilities. They are reimbursed by private insurance and Medicare and Medicaid, and those organizations have continued over the last 3 years to dramatically expand reimbursement around our services. So essentially, if you have a patient who's got, let's say, congestive heart failure, and they're at home, we know that in the developed nations, less than 20%, or rather around 20% of all of the population have chronic diseases, but they account for 70 to 80% of all of our healthcare spending, because those patients are responsible for managing their own conditions in the home on a day-to-day basis, and they don't tend to do a great job. Less than 50% of them take their medication as prescribed. So little interventions in the home can have a big impact on that population. And what we do, we have a cloud-based SaaS software, and we connect to patients' devices. So if you have congestive heart failure, you'd have a scale in your home, maybe a blood pressure cuff. If you also have diabetes, you have a glucose meter. And we collect the data from those devices and immediately upload it to our cloud, where we deliver alerts, automated alerts to your clinical care team if you're starting to destabilize. So something like a 2-pound weight gain in a congestive heart failure patient in 24 hours indicates they're going into heart failure. And if their clinician calls in a prescription for a new diuretic, maybe change their cardiac meds, they can keep that patient healthy and at home indefinitely. But if you wait until the patient starts to experience physical symptoms like chest pain or pressure or difficulty breathing, then that patient's looking at an ICU stay in the hospital. And that costs the healthcare system hundreds of thousands of dollars. So little interventions like we enable with our proprietary technology have a dramatic impact, not just on patient health outcomes and quality of life, but certainly on healthcare spending. Excuse me.
So essentially what you're able to do is you're able to offer, the insurance companies, et cetera, really kind of like a no-brainer solution that, they're going to, pay. What's the cost of your, so in other words, they're going to get a positive ROI right away. So in other words, the cost of your service is how much per month? It's a SaaS, so it's how much per month?
Yes, so we charge an average of $40 US per patient per month, but the clinicians who use our services receive an average of $315 per patient per month from Medicare and Medicaid, and if they use our services. So that's a brand new revenue stream for them, and it's almost pure profit. So there's a very compelling market pull for our technology right now, with in healthcare. When we started in sort of late 2017, 2018 with patients, and there were billing codes in a few states under Medicaid. And in January 2018, Medicare, the federal program, introduced one billing code for remote patient monitoring. And clinicians could make approximately $59 per patient per month by using our platform. 59 back in 2018. Since then, they've introduced.
Can you explain for anybody who might not know the billing code? What does that mean? Like,
right. So what it means is that Medicare and Medicaid have said, we want patients to receive this virtual care. We know it keeps them out of the hospital. We've demonstrated with clinical data that this keeps patients healthier and therefore they cost the system less. So we're going to provide this service through physicians or home health or skilled nursing facilities, and Medicare and Medicaid are going to pay for it. But when they started paying for it in 2018, it was you could only make as a physician or home health around $60 per patient per month. They've since, over the last 3 years, increased the number of billing codes available from 1 to roughly a dozen. So the number of possible services that are covered that use our technology, and they've increased the size of that reimbursement from $60 to $315. So an average physician practice can bring in a new revenue stream of between $500,000 and $1 million a year just by deploying our platform.
Okay, that's okay. So this is a key point.
Yeah.
So let's say a doctor so basically, a doctor has a bunch of patients. He's getting another 500 grand, $1 million right to the bottom line.
Yeah, okay. Exactly, because Medicare and Medicaid have recognized that the average cost of care for a chronic disease patient, because they end up in the ER, because they end up in the ICU, is anywhere from $25,000 to $250,000 a year. But if you use our platform, so you provide that more proactive care, you can bring the cost of care for that patient down to $2,000 to $4,000, depending on what medications they need. So it's a huge cost savings, and it's ultimately going to enable Medicare and Medicaid to devote $50 to $100 to $200 billion to this upfront proactive care, but save $1 trillion on the other end.
Okay, so basically there's kind of a I like these things where there's a no-brainer argument for deploying the solution, so that makes things easy. There's already an incentive. There's a significant financial incentive for the doctors to recommend their patients use this, and also the insurance companies. They have, they see this, clearly as a major cost savings. And one thing stuck out. So in terms of how big is the market opportunity? You just mentioned a couple numbers. So what's the size of the market opportunity really that you're addressing?
Right.
Reliq, what are the total markets that you're addressing like right now?
Yeah, our total addressable market is over 100 billion US. We are targeting primarily the 37 million Medicare and Medicaid patients who have 2 or more chronic diseases. But as we move forward, we're getting more and more interest from the private insurers who have a similar patient population, if not larger. So it's an absolutely massive patient population and a very large market that's only expected to grow as the population grows and ages.
Okay, and now how does the technology work? Because I know there are various companies doing different things in this sector. Everybody sees the same opportunity that you're looking at. What do you do differently?
Yeah, so we built our platform specifically for the community markets. If you look at healthcare has traditionally had the bulk of the budget from insurers, whether private or government funded, was aimed at the acute care space, so hospitals. The community care space is everything outside of the hospital. And so the way we save money in the acute care space, we close small rural hospitals, we close or reduce the number of beds in large hospitals, we reduce the length of stay for patients. So, if you have a mastectomy, you might be out in 3 days instead of staying for a week or 2 weeks. But that's really just rearranging the deck chairs on the Titanic, because only 20% of the budget that's in acute care is really going to be affected by those kinds of changes. Whereas the 80% of healthcare spending that's going to chronic disease patients, the reason that they're so expensive is because they have a lot of preventable complications. And the way you prevent those complications that lead to these really costly ICU stays is by encouraging them and providing some accountability, some engagement, so that they are checking their vital signs every day, they are taking their medication, and you get an alert if they're not. And that really seems to get them involved in a more proactive way in their care. And so the way that other companies in the space like Vivify, as an example, or Philips, or even TELUS, have engaged with the healthcare system traditionally on virtual care has been aimed at hospitals. So integrating with hospitals' electronic medical record systems, taking their patients post-discharge for that 30-day window during which there are potential penalties for readmissions. But those systems are very complex. They're what we call very heavyweight. So they require a hospital IT team, which would have dozens to hundreds of developers, to both support the implementation and deployment, but also ongoing support and maintenance. So they're millions of dollars up front, millions of dollars a year. And that won't work in the community, because in the community, the skilled nursing facility, the home health agency, the physician practice, they don't have an IT department at all. So they can't manage a really heavyweight layer. What they need is something that lives in the cloud, so they don't have to have their own server farms, that's incredibly intuitive and that really matches that community-based workflow. And we built that from the ground up, and what we have in the market is very unique in that respect. It's very, very quick and easy to train people to get it up and running. If you sign a contract this morning, we can have you up and running by tomorrow, fully trained. So it's a very intuitive interface. But we're looking at the patients that we're serving. I think that's where there's some key differentiators. So most of the chronic disease patient population, our average patient age is 75. So they're elderly. They're coping with multiple very significant chronic diseases like congestive heart failure or chronic obstructive pulmonary disease. So if you give them an app on a tablet or on their phone or a computer interface, these are not patients who are tech savvy. They may have visual acuity issues, and they're not keen on learning new technologies. So you have to be able to meet them where they are. So while we do have apps and web interfaces and very slick UI in that perspective, from that perspective, we don't require that our patients use that. So for patients, particularly in rural and remote and low income communities, we provide them with devices that will monitor their blood pressure, their weight, their blood glucose, whatever is relevant, that are actually have a little SIM card installed. The devices themselves will remind the patient in the language of their choice to take their vital signs during the day. And then using that SIM card over the cellular network, we collect the data directly from the devices. So the patient doesn't have to manually enter any data. They don't have to log on to a system. They don't have to have a smartphone, and most of them do not. And most of what's been developed in the community was either aimed at these hospitals with very complex IT systems who could cope with that, or there's a lot of little kind of mom and pop shops that do remote monitoring or telemedicine or behavioral health integration or chronic care management. And those systems tend to either have been designed by developers who are in their 20s and have no understanding of what it's like to be a senior citizen, and they're therefore not usable, or they've been developed by physicians who are great at the workflow piece, but terrible at the technology piece. And the other sort of landscape or point in the landscape would be companies like Abbott or Baxter that have hardware. So glucose meter, and they have an app that allows the patient to collect data from that glucose meter and possibly share it with their clinician. But what we consistently hear from clinicians, and this was true, running my previous company as well in healthcare, is they don't want to log on to different systems to see their patient's blood sugar or blood pressure or cardiac data. They want all of it in one system, and that system has to be extremely usable. And so we have, unlike any other company in the space, we have an extremely comprehensive suite. We have telemedicine, chronic care management, remote patient monitoring, behavioral health integration, transitional care management, principal care management. So wherever you are in that patient circle of care, we have a product that will allow you to monitor the patient and to be reimbursed for that. And it's very, very easy to use, particularly for those sick elderly patients.
So, Lisa, what kind of traction do you have? I know you had a news announcement today with this California deal. I guess it's a community. It was California. It's a California Care Management Network. So can you?
Yeah.
What is this deal about?
Yeah, so it's essentially a managed care organization. So they are working with a very large patient population across California. They're the first mover in sort of healthcare offerings specific to the Asian American community, and there's a very large Asian American community in California. And California, of course, is the largest state by population. So, having a presence throughout that state with this new contract where they have 50 clinics and over 500 physicians, that's a huge step forward for Reliq, and certainly will open more doors for us on the west side.
You said that they have how many clinics they have?
They have 50 clinics, 50.
Okay, 50 clinics. So, if I use the numbers that you mentioned earlier, this is potentially for them, 50 million in revenues.
Mm-hmm.
To their bottom line, and to your bottom line, what kind of revenues could this deal mean?
Yeah, I mean, we haven't
deal alone, basically.
Yeah, we haven't specifically disclosed that, and this probably isn't a form of permitted disclosure. But what I will say is, with those large patient numbers, an average physician practice has approximately 3,000 patients per physician. Of that 3,000, approximately 20% or 600 will be chronic disease patients, and so those would be the patients who would be onboarded onto our platform, as well as any patients they have who are elderly and relatively healthy but are aging in place and would use the You Go Home platform. So the bottom line is this is a massive contract for us that has enormous revenue potential. When we go live with this client, which we'll do next month, we'll be able to issue a follow-up press release with more details and more quantitative metrics, and also more information on the actual network itself. But this initial announcement is relatively general, and we're probably going to have to stick with that. But
somebody's going to have to replay this and do all the math and run back through the numbers. Okay, so basically, if I'm just doing so, you get roughly how many potentially, just for anybody that is not good at math like myself, potentially how many patients do they have in their pool who could be, using your service?
I mean, certainly they have over several 100,000 patients and a significant
prospects.
Sorry?
There are several 100,000 patients that are potential prospects for your telehealth service.
They would have, well, probably more than several 100,000 patients, but the patient prospects for us would certainly be in the, what would you call that, 6-digit range.
Okay. Okay, so substantial numbers. Okay, what other kind of traction? How many of these? What other kind of traction do you have in the market? And are things accelerating? Give us maybe kind of a history of how things have been progressing.
Yeah, I mean, when we started working with patients in 2017, 2018, we were just in South Texas, and all of the billing codes, all two of the billing codes, one through Medicare and one through Medicaid, were new. And there was a lot of, kind of chaos and confusion that first year. That's not atypical with the new billing code with Medicare and Medicaid, that they'll put out a new billing code, and then when claims start flooding in, they'll kind of panic a little about how much that's going to cost out of their budget, and they end up not allowing a lot of those claims. So that was definitely a chaotic year for anyone in that space. But since then, the reimbursement codes have increased. Medicare and Medicaid have been able to document for themselves over the last 2 to 3 years that there are significant cost savings and improvements in clinical outcomes by using remote monitoring and other virtual technologies. And so we have continued to expand beyond South Texas. That was a logical starting point for us because in healthcare, it's a very conservative market. It's very hard to get new customers when you're an unknown quantity. And so we started off in South Texas because it has the highest rate of chronic disease of any community in the US, very, very high rates of diabetes and hypertension in particular, as well as congestive heart failure. So we worked with clients who were some of the most challenging clients in the space, quite small and not necessarily familiar with technology. A lot of them had paper-based systems. Over the last few years, we've expanded significantly. We have over 50 clients now in the US. They have practices and skilled nursing facilities and home health agencies in all of the 48 contiguous states in the US. So we've definitely expanded geographically, as well as going from mostly working with small home health agencies to now primarily working with large networks of physician practices or skilled nursing facilities. So we have a much I don't want to imply that our early clients were not sophisticated, because they were extremely passionate and very caring clinicians. But we have more clients at this point who are in the business of healthcare, if you know what I mean by that. So they're better able to scale quickly and to deploy new software solutions, and they have a lot of experience with CMS as well as with private insurers.
Okay. So in terms of so what kind of what kind of run rate are you at right now? Like, and where do you expect to exit?
Yeah. So we've said, I think, publicly that revenue will grow every quarter going forward. We expect that by the end of June we'll be at a run rate of $1.5 million, but by the end of the year we expect to have done around 11 million in revenue and be at a significantly higher run rate than 11 million, so probably closer to 25 million at that point. So this year is really going to be about explosive growth for us. We've spent kind of the pandemic year really preparing for that, and with the contracts that we have now, we've provided projections to the market, and I think with the challenges that the US has faced, which are not as significant as the ones we've had in Canada, but around vaccine distribution and administration, it's likely that won't be till end of June that all frontline healthcare providers and patients over 75 will be vaccinated. But at that point, that really removes kind of the last few obstacles to rapid deployment of our solutions. So the second half of this year is really where we're going to see the most significant growth for this year. The growth we see in the second half of this year is likely to continue on in subsequent years for quite a long time, because as I mentioned, only 3 to 5%, or I think I mentioned, only 3 to 5% of all of the patients who qualify for our services are currently receiving them. And the reason for that is that, the billing codes are relatively new. So it's really only the last 2-3 years that clinicians have started to accept them and look at new ways to practice. Certainly with the pandemic, that has accelerated the adoption and acceptance of virtual care by probably a decade. So while the pandemic year itself was a rough one for us, certainly hit our clients in Florida and South Texas very hard, it did encourage us to diversify geographically to all 48 states, the mainland states, as well as Puerto Rico and Australia, frankly. But that's really going to drive accelerated adoption, and certainly Medicare and Medicaid have not only introduced these carrots of the reimbursement codes, they've also introduced a lot of penalties around not providing these proactive services. So
that's good. People are more motivated by pain than pleasure, right? So that's a good.
Yeah, it's a bit of both, but I mean, there is both now. So particularly on the skilled nursing.
Fear of loss. Doctors are more conservative. I think that fear of loss is like people don't want liability.
People don't want the liability. People don't want the change in lifestyle associated with losing a relatively significant percentage of your revenues to penalties. And for skilled nursing facilities who operate on very thin margins to begin with, those penalties can be the difference between staying afloat and not. So using our technology not only prevents them from incurring those penalties, but it introduces new sources of revenue for them. And that's hugely important as that sector goes forward trying to recover from COVID, where so many people didn't want to be in a residential care facility where the risk of an outbreak was so high.
So there's a carrot and stick basically for the market to deploy your technology. So you mentioned something interesting. Okay, so you expect that you could hit a run rate of 25 million end of year. So in other words, you're expecting the key growth is going to start sometime in the second half, basically.
Yeah, I mean, we're already seeing growth, no question. But I think, the key growth is going to hit in the second half of the year. And it will be very rapid from then on. I think for minimum of 3 to 5 years, we're going to see this very, very rapid growth. And both the platform and the company's infrastructure over the last year have all really been reinforced and built and around that expectation of significant, very rapid growth.
Okay, so 25 million exiting 21 with potentially 25 million run rate, things are picking up from there. So, really right now you're at this inflection point, which is, what we like here, on this program is we like those companies which right now, they went through, all that pain of development, years, whatever. And now, this is, so in other words, we get the baby without the labor. So this is, so right now this is the point to look at the stock right at that inflection point where revenues are coming in. Here's what's interesting. Okay, so let's talk about the comps in your space.
Sure.
What are the comps like? Because you're in you're health tech, but also SaaS. So
Yeah,
that's the
exactly. Yeah. So typical multiples for companies in our space would be, 10 to 30 times revenue, 20 to 40 times, or even 50 times EBITDA. And so they're very significant multiples, and they tend to be on the higher end of the range if the company is showing active growth and is profitable, which is certainly the position we'll be in by the second half of this year. I think, frankly, we're going to have higher growth than, any other company in this space, organic growth, certainly. So, we are expecting to command those higher multiples. If you look at some of the companies that have been bought in this space, Vivify by United Healthcare, Livongo by Teladoc. Livongo was valued at, I believe, $18.5 billion when they were purchased, at a time when they were still losing money. And they are forecasting margins over the long term of between 10 and 15% EBITDA margins. Our forecasted EBITDA margins by the end of this year, which would only improve going forward, are over 45%. So, we have a very compelling business model when it comes to valuation, looking at comparables in the space. So I think there's a lot of room to grow in terms of the company's current valuation. And I think, that's a big part of why we're looking at, a NASDAQ listing, and in the, relatively near term, or early next year. I think we'll start, moving towards that goal. And certainly there's a premium that companies get when they uplist to the NASDAQ that, makes a lot of sense in terms of capturing shareholder value. But, more to the point, our largest customer base is the US. So while we may be a Canadian company, and we do have offices in the US, in Florida and Texas, that's likely to continue to expand. And the audience for us is really primarily US shareholders, simply because
NASDAQ loves healthcare.
Yeah.
Okay, so Lisa, so basically, if you're exiting 20 now, how much, I forgot, with Livongo, how much were they doing in revenues when they were bought for $18 billion?
So they were still losing money. They were certainly doing well. Probably looked up. Why don't we come back to that next time we talk?
Okay.
Remember, because I don't want to misspeak on someone else's business.
But basically, the market. The market essentially in your space. Yeah. When the market sees velocity of revenue growth, then they could pay 30, 40x revenues. So it's potential. There is a possibility. I think there is a runway for the stock to be, for the company to have, 40x. A $1 billion valuation, let's call 12 months from now, you tie it back now, you kind of, but so, there is a runway for this thing to be a 10-bagger stock from where it is right now. Assuming you start hitting those numbers, we got to see these contract revenues over the coming months. So I think the key thing is going to be to watch the pace, the velocity of those new deals coming in, the revenues. Very interesting. I got a couple. So let me go to some audience questions here. I think you answered a few of them already. But I think one of the questions I had, which here we have an audience question I think is very good, is where's the moat question? The moat. Okay, so here we go. So Ramsey, what kind of moat do you have, from the technology standpoint? And also, please explain cross-selling services that you envisage.
Yeah. So the moat, there's a number of different moats. One is just that we're the most usable solution, and we're one of the only solutions in the world that offers the full suite of products that we have. But the real moat around us, and which I always stress to anyone who's not familiar with the space, is that healthcare is so conservative. So when we started out, we had to work with those smaller, more challenging customers. We collected, over 2 years worth of clinical data, and that's really kind of the price of admission. So you need to have about 2 years of solid clinical data showing that patients do have those improved health outcomes, that we're able to reduce the average rate of hospital admission in this population. About 1 in 5 of these patients will be hospitalized in a year normally. With us, that's well, it's roughly 20%. With us, we can reduce that to less than 1%. So it's a dramatic difference in terms of health outcomes and in terms of cost of care. Without, pardon me, so a new entrant to this market would need to get out there and then spend 2 years generating comparable data that shows usability as well as efficacy, safety, issues around, claim submission. So we've got a pretty good head start. And the healthcare market is one where people, if you ask your family doctor how he likes his electronic health record, 95% of them will say they hate it more than anything. But in this market, they like to buy based on reference, so they like to use what others are using. We have a first mover advantage in the community healthcare space in that $100 billion market doing what we do. And we do get a lot of our clients now from inbound sales. So customers who've done global searches looking for a platform that meets their needs, who come back to us and say, you're the only thing out there. So it's going to be very difficult to get anybody to switch away from us if something new comes into the market. But no one's really going to be able to even potentially compete until they've generated that 2 years worth of clinical data.
Okay, so here's the number. So Livongo is doing 60 million a quarter.
Yeah.
So they were bought at a big number. So 240 million. I mean, it's 18. It's a massive number. I think it's more than 40x.
Yeah, I mean, the announcement they had about the deal was an $18.5 billion valuation on Livongo at a time when they were doing about, if we do that math, 240 million in revenue, but were EBITDA negative. So.
Okay. We have a couple of people asking about exit strategy. Do you see the company being sold to a larger company? CloudMD, which is one of our clients, or or Teladoc. I don't know. There's
yeah, I mean, I think I know that Well and Cloud are moving into the US, but I think there's still a relatively unknown quantity down there. So I think the more likely potential acquirers for us would be an Amazon or one of the big healthcare payers, like United Healthcare bought Vivify. So, there's lots of other big payers out there, Humana and others. And I think those are more likely if we look at the trend to consolidation in this industry. I think in order to acquire a company like ours and continue to make it successful, you have to have a lot of depth and experience with the US market, particularly on the regulatory side, which at the moment, companies like Well and Cloud don't have. Not to say that they're not looking to bring that along. But Well and Cloud have such a big presence in Canada, and in Canada we have no billing codes for the services that we offer. So, it would be a play that would purely expand on their U.S. business, and I think would probably make more sense for some of the other.
It would have to be somebody. I mean, basically, look, there is a number of players, like you mentioned, Amazon. There's a bunch of players who, if they can write a check for a couple of $1 billion, it's not a big deal.
Right.
As long as they see like you have traction, just I think the Livongo deal basically kind of paves the road in two ways. One is for potential buyer, but also for institutional investors. I mean, because the institutions in the U.S., they really can't buy your stock just yet. So until it's NASDAQ or whatever. So I think that's why I think there's this opportunity for the retail investors right now. But at some point, they're going to look at that. Once you're NASDAQ, they're going to say, okay, Livongo was bought for X. I mean, that becomes their story. I mean, they can understand that easily. They can understand the upside because of the Livongo deal.
Right. And we have to keep in mind, Livongo, their product serves the type 1 diabetics, and that's 10% of the diabetes market. We address the other 90% plus that 10%, plus all the other chronic diseases. So we have a much broader offering than what Livongo has. And Livongo's EBITDA margins are so much lower, even forecast, than ours will be because it's a very human resource intensive business. So they use a lot of case managers to have kind of very frequent communication and coaching sessions with the type 1 diabetics. And what we have as a pure SaaS model is really much more scalable.
Okay. So we're running a little bit behind, so we're gonna wrap up in a few questions. Let's throw out some tough questions here, which I like this. What happened around 2018 that caused the stock to tank? Because if I look at that chart, you see 2018 it had that.
Yeah, no, 2018 was like the Black Plague year for me, and it was not a fun year. So we had the experience that a lot of companies in our space had, where, because it was the first year that Medicare had introduced a billing code for RPM, there was a lot of confusion around who qualified as eligible patients. We ended up with quite a large percentage of patients that we had already onboarded turned out not to be eligible. So what we've done in the wake of that, we had to write off a big chunk of revenue as bad debt. And what we've done to prevent that kind of thing from ever happening again is we built connectors into all of the state Medicaid databases and the federal Medicare database so that we can pre-screen patients for eligibility and submit pre-authorization forms. So never again will a patient who's not eligible for reimbursement be put on our platform. Other companies in the space just rely on the clients, the healthcare organizations, to do that pre-screening, but once bitten, twice shy, we're not going to make that mistake again. We also had some issues in 2018. We'd acquired a company in 2016 called CareKit Health that was the foundation of our platform. Some of the team that came in either immediately through the acquisition or related through some of the senior people that we brought in through CareKit who hired their own team. Essentially, and this is public knowledge, set out to kind of develop a competing business and steal our source code and our customers. So we had to enter into litigation. That was resolved in our favor. A settlement was paid, but it was a challenging year. I mean, we've certainly been through the fires, and I think that's a benefit of getting involved with the company now. That we've had those experiences. We've put in place not just on the screening side, and we've changed our contracts around when we get paid, and to increase the certainty that we get paid, so that we know the second a patient is onboarded, we will collect that revenue. But beyond that, I've really worked hard to strengthen the company. We originally had the bulk of our personnel in Vancouver. At the end of 2018, I closed that office, moved it to Hamilton, where I live, just outside of Toronto, and rebuilt the team I took it down to 3 people, myself, the chief medical officer, and one of the founders, and rebuilt it back up to, I think we were over 30 people now, and brought in, really strong CFO, and we brought in KPMG as our auditors. So, we have a lot of rigor now around all of the company systems that maybe wasn't there when we were, a young company and just, starting out, and a lot of companies in the States got, kind of caught in the early days of RPM as well. But we're a company that's, really very mature in terms of its infrastructure, and we're right at that point where we're ready to start really demonstrating that shareholder value. And Jack, I'm an engineer by training, and we have been very quiet.
You're a PhD also.
Yeah, in chemical engineering. Yeah,
Dr. Lisa.
Yeah, well, no, Lisa. But we've been really quiet in the market for the last 2 years because there was uncertainty in the business, and I'm not comfortable getting out in front of the market talking based on anything other than data. And now we're at a point where I'm really comfortable getting back out in front of the market because we know everything's locked down, internally. We're really ready to go and to support this growth. And we have the contracts with these much larger clients, and that we know, the revenue projections are based just on the contracts we already have, not based on the business development that's a constant ongoing activity for the company. So we're really in a position where I think it's a good time to get involved with the company. I think new investors will benefit from the lessons we learned in the rocky years, and investors who stuck with us, I think, will be very pleased that they did.
Yeah, we're gonna 2 questions and then we're gonna wrap up. But I think I want to make a comment here. Is that I think the key thing is, a lot of retail investors, I think, hey, you buy microcap and go straight to the moon, one-way ticket. The reality is, essentially, we're in the public venture capital business, right? So these are startup companies. Everybody hits a road bump. I mean, every company hits a road bump. So the time to get in is after they went through all that. After, so again, we want the baby. We don't want the labor, the pregnancy. We just want the so now is the inflection point. Lisa, I want to ask you mentioned your engineering background. So just tell us a little bit about your background and team.
Okay, I'll do that very quickly. My background, my first degree was in life sciences. My next degree was chemical engineering, another undergrad, and then a PhD in chemical engineering focused on manufacturing drugs using mammalian cells or animal cells. I moved to Boston once I was finished my postdoc, and worked at a biopharmaceutical company that went public in the summer of 2000, started the day at $15 a share, closed the day at 45. So very successful IPO. I was part of the dog and pony show for that IPO, so that was my first exposure, particularly to the US capital markets. And then this is the fourth company that I've run as CEO. I've sold my previous privately held companies. The first one was sold to Millipore. The second one was sold, the third one most recently, VitalHub was sold to the guys who just exited MedWorks, and they've since taken it public. And this is the first company I've run in Canada on the public markets, but I've been here for 5 years, and I think we have a lot of strengths going for us. And when I brought in the new team, we have now extremely solid depth on the technical side with our chief product officer, chief technology officer, our chief innovation officer, and has a lot of experience in the tech space and comes out of a very famous academic institute in Toronto, the Institute for Biomaterials, and I think it's bioengineering. So we have a really solid team in terms of both the current technology and looking forward to the next generation. And then we've focused very much on building a really strong team in the US for business development. So very senior people who have a lot of experience working in the space and are very well connected at the C-suite level to a lot of big healthcare clients. So I think we have a really solid team that can absolutely grow this to $1 billion business and beyond.
Okay. Key point there, $1 billion business and beyond. So on that note, what's your vision for Reliq 2-3 years out? Yeah, 2-3 years, by the way, is way beyond the time spent. Our audience wants 2-3 weeks, but the reality is 2-3 years out, what is Reliq going to look like, assuming things go more or less on track?
Yeah, I mean, I think Reliq will be, without question, the market leader and have dominant market share in the virtual care remote monitoring space 2 to 3 years out. We will have a very large customer base in the US primarily, but hopefully Canada will have come around a bit by then, and there'll be opportunities for us here. We are getting traction in Australia as well, and I expect us to continue, global expansion in 2022 and 2023. Certainly for the near future, the US is our primary focus, but I expect us to be the market leader in this space within the next 2 to 3 years. And I expect that this year alone is going to be a really significant growth year for us. So while we can't, ever guarantee in healthcare that, you're looking at a more conventional kind of pot stock, let's say, or Bitcoin, there certainly are and have been very significant valuations in this space recently. And so I think there's a lot of opportunity long-term, but also a lot of opportunity short-term. Okay.
We're going to wrap up. Upcoming milestones. What do you have coming up the next, let's call it next 30 to 90 days? What are the key milestones that investors should keep an eye on?
Yeah, I mean, definitely in the next quarter, we'll be hitting profitability. That'll be a really key milestone for us.
Profitability.
Next quarter profitability. And then I think beyond that, investors will be able to see that month over month, we have increasing revenues for the foreseeable future. Certainly over the next, year, 2 years, 3 years, there'll be significant revenue increases every month. And also watch for the new contracts. We certainly aren't letting up on our business development efforts.
Okay. Lisa, last question. This is our favorite question that we ask at the end of every interview. Top 3 reasons why investors should consider Reliq right now.
I think this is a key year for us. This is really going to be our breakout year. We're kind of at an inflection point or just before an inflection point, and one of the key milestones around that is hitting profitability. But we're going to see very rapid growth this year, so this is a really good time to get involved with the company, because I think we're still at a very early stage, but we'll be a very different company by the end of this year. I think in terms of number 2, our second reason, over the last 2 to 3 years, Medicare and Medicaid have gone from having one reimbursement code that was valued very low in terms of the amount of money that our clients could generate in revenue using it, to now over a dozen reimbursement codes and a significantly higher level of reimbursement that allows physician practices to generate between $500,000 and $1 million in new revenue. So there's a lot of new market pull for us in the space. And then I think, there's, as I've said, I think at some point during this conversation, only 3 to 5% of the patients who are actually eligible for these services are currently receiving these services. So there's a huge amount of room for growth in this sector, and with the combination of those reimbursement changes and also just more understanding of the value of virtual care as a result of the pandemic, I think that market is really poised for explosive growth. So it's a good time to get started in this sector.
Lisa, this is, my comment is kind of from a technical perspective, or maybe like a old Wall Street superstition, is that, stocks tend to go back to their old highs, because if they did it once before, there's a good chance they could do it again. So, that's one of those things.
Yeah.
Okay, Lisa, on that note, I want to thank you. We're going to catch up with you, probably the next week or two, and we look forward to hearing more good news.
Great. Thanks so much for having me.
Thank you.